two of the biggest companies on the planet. One delivers packages to your doorstep in 2 days. The other runs the largest chain of physical stores in human history. Amazon versus Walmart. Both are giants. Both are household names. But when you actually look at the numbers, the revenue, the profits, the debt, the valuation, which one is actually in a stronger position right now? That's exactly what we're going to find out today. We're going to take the raw financial data for both companies and break it down, simply, clearly, and step by step, so that by the end of this video, you'll know exactly where each company stands. No jargon, no guessing, just the numbers explained. Let's get into it. Amazon is best known for its online shopping platform, but that's just the beginning. Amazon also runs Amazon Web Services, which is a massive cloud computing business that powers a huge chunk of the internet. They're also in advertising, streaming, and a whole lot more. Think of Amazon as a tech and retail hybrid. Walmart, on the other hand, is the world's largest traditional retailer. They run thousands of physical stores across the globe, the big box stores you drive to every week for groceries, electronics, and everything in between. They're also growing their online presence fast. Think of Walmart as a retail giant that's evolving for the digital age. Both are enormous, both are growing, but they operate very differently. And that matters when we compare the numbers. Okay, let's start with the basics. How big are these companies? Amazon's market cap, meaning what investors collectively think the whole company is worth, is $2.88 trillion. Walmart's market cap, $1.05 trillion. So Amazon is almost 3 times the size of Walmart in terms of what the market values it at. That's a massive gap. Now, when we look at revenue, which is simply the total amount of money each company brings in, here's what we see. Amazon brought in $742.78 billion in the last 12 months. Walmart brought in $713.16 billion in the same period. Now here's something interesting. The revenue is actually very close. Walmart is nearly keeping up with Amazon in raw sales, but revenue alone doesn't tell the whole story. What matters is what a company does with that revenue, and that's where things get very different. This is the most important section, because here's where we see how efficiently each company is actually running its business. Let's start with profit. Amazon turned its $742 billion in revenue into $90.8 billion in profit. That's an enormous amount of money left over after all expenses. Walmart, on the other hand, turned its $713 billion in revenue into only $21.89 billion in profit. So while their revenues are similar, Amazon's profits are more than 4 times higher than Walmart's. Why does that matter? It tells us that for every dollar Amazon makes in sales, it keeps far more of it compared to Walmart, and that brings us to profit margins, which is just the percentage of revenue that turns into profit. Amazon's profit margin is 12.22%. Walmart's profit margin is just 3.07%. Think of it this way. If Amazon and Walmart each sell $100 worth of goods, Amazon pockets $12.22 in profit. Walmart only keeps $3.07. This is not surprising when you understand their businesses. Walmart is a traditional retailer. They have massive stores, huge logistics operations, and razor-thin margins by design. It's a high-volume, low-margin business. Amazon, especially with its cloud and advertising arms, operates at much higher margins. Now let's look at gross margin, which tells us how much money is left before operating costs. Amazon's gross margin, 50%. Walmart's gross margin, 24.93%. Amazon keeps 50 cents of every dollar in sales before expenses. Walmart keeps about 25 cents. This reflects how different their business models really are. Bottom line, on financial performance, Amazon is significantly more profitable and more efficient at turning revenue into actual profit. Now let's talk about valuation. This is where investors figure out whether a stock is cheap or expensive. The most common measure is the PE ratio, or price-to-earnings ratio. It tells you how much are investors paying for every $1 of profit the company makes. Amazon's PE ratio, 32.08. Walmart's PE ratio, 48.21. A higher PE means investors are paying more for the stock relative to its current earnings, usually because they expect strong future growth. Walmart's PE of 48 means investors are paying nearly $48 for every $1 of profit Walmart earns right now. That's quite expensive. Amazon at 32 is also not cheap, but it's lower than Walmart, which is actually surprising for a tech-heavy company. Now let's look at the PEG ratio, which adjusts the PE ratio for expected growth. A peg below 2 is generally considered more reasonable. Amazon's peg, 1.58. Walmart's peg, 4.81, a peg of 4. 81 for Walmart means investors are paying a very high price, even after accounting for expected growth. Amazon's 1.58 is far more in line with what you'd expect. Now here's where things get interesting, or the PS ratio, or price-to-sales ratio, compares a company's market value to its total revenue. Amazon's PS ratio, 3.88, Walmart's PS ratio, 1.47. Amazon's higher PS ratio makes sense. It generates much higher profits from its revenue. Walmart's lower ratio reflects that it's a thin-margin retail business. Bottom line on valuation, by most measures, Walmart appears more expensive relative to its earnings and growth. Amazon, despite being a larger company, looks more reasonably valued on a growth-adjusted basis. Now let's check under the hood. How healthy are these companies financially? This is about their debt, their cash, and their ability to handle tough times. Cash on hand. Amazon, $143.09 billion. Walmart, $10.73 billion. Amazon is sitting on a massive cash cushion. Walmart has far less cash available. Total debt, Amazon, $209.89 billion. Walmart, $68.43 billion. So Amazon has more debt, but it also has far more cash and far higher profits to service that debt. A useful measure here is the debt-to-equity ratio, which shows how much of the company is financed by debt versus by its own money. Amazon, 0.47, meaning debt is less than half of its equity. Walmart, 0.64, a bit more leveraged. Both are manageable. Neither company is drowning in debt. But here's a key difference. The current ratio, which tells us if a company can pay its short-term bills using its short-term assets. Amazon, 1.18, meaning it has more current assets than current liabilities. That's a healthy sign. Walmart, 0.79, meaning Walmart's short-term liabilities actually exceed its current assets. A ratio below 1 isn't always a red flag for a massive company like Walmart. They have consistent cash flows. But it's worth noting, interest coverage? This tells us how easily a company can pay the interest on its debt from its operating profits. A higher number means more comfort. Amazon, 33.72. Amazon could cover its interest payments more than 33 times over. Extremely comfortable. Walmart, 10.66. Still solid, but clearly much lower than Amazon. Bottom line on financial health, Amazon holds a stronger financial position overall with far more cash, a lower debt burden relative to earnings, and exceptional ability to cover its debt obligations. This section is all about how well each company uses the money it has to generate more money. Think of it as judging how smart each business is with its capital. Return on equity, ROE. This shows how much profit a company generates for every dollar of shareholder investment. Amazon, 24.28%. Walmart, 21.85%. Both are strong. Amazon edges out Walmart, but they're close. This means both companies are doing a respectable job rewarding their shareholders. Return on invested capital, ROIC. This is one of the best measures of business quality. It shows how much profit a company generates from all the money invested in it, both from shareholders and from lenders. Amazon, 13.84%. Walmart, 13.90%. These are almost identical. Both companies are generating about 14 cents of return for every dollar invested in them. That's actually a good sign for both. Now, here's a very important comparison, ROIC versus WACC. WACC stands for Weighted Average Cost of Capital, and it basically tells you what it costs a company to run its operations, paying interest on debt, returning value to shareholders, etc. If ROIC is higher than WACC, the company is creating value. If it's lower, it's destroying value. Amazon, ROIC, 13.84% versus WACC. 11.55% implies creating value. Walmart, ROIC, 13.90% versus WACC. 7.59% implies creating significant value. Both companies are creating value, but Walmart actually has a bigger spread between ROIC and WACC, which means dollar for dollar, Walmart is creating more economic value with its invested capital. That's a point in Walmart's favor. Let's quickly look at how these stocks have performed recently and how volatile they are. Over the last 52 weeks, Amazon stock is up plus 45.46%. Walmart stock is up plus 35.32%. Both have had a great year. Amazon has outperformed, but it also comes with higher risk. The beta tells us how much a stock moves compared to the overall market. A beta of 1 means it moves with the market. Higher than 1 means more volatile. Amazon's beta, 1.47. Amazon moves significantly more than the market. When markets go up, Amazon tends to go up more. When markets drop, Amazon can fall harder. Walmart's beta, 0.66. Walmart is actually less volatile than the market. It tends to be a steadier, more defensive stock, the kind that holds up better during tough economic times. This tells us something about the type of investor each stock attracts. Amazon appeals to investors comfortable with risk and chasing growth. Walmart appeals to investors who prefer stability and consistency. Analyst targets. Amazon's average analyst price target is $302.93, suggesting about 12.92% upside from the current price. Walmart's average analyst price target is $133.86, suggesting only about 1.72% upside. Analysts see more room to grow in Amazon at current prices. Both hold a strong buy consensus, but Amazon's expected upside is considerably larger. All right, we've looked at the data from every angle. Let's bring it all together. Here's what the numbers are telling us step by step. Round 1, profitability. Amazon wins. Amazon earns more than 4 times the profit of Walmart on similar revenue. Its margins, both gross and net, are dramatically higher. Amazon is a significantly more profitable business. Round 2, valuation. Amazon wins. Despite being a larger company, Amazon trades at a lower PE and a far more reasonable PEG ratio. On a growth-adjusted basis, Amazon looks more fairly valued than Walmart right now. Round 3 and financial health, Amazon wins. More cash, manageable debt, a healthy current ratio, and exceptional interest coverage. Amazon's balance sheet is stronger. Round 4, capital efficiency, Walmart wins. Both companies have nearly identical ROIC, but Walmart's WACC is significantly lower, meaning it's creating more economic value per dollar invested. This is a genuine strength for Walmart. Round 5, stability and dividends. Walmart wins. Walmart has paid a dividend for 53 consecutive years and is still growing it. It has a much lower beta, making it a steadier investment in turbulent markets. Amazon pays no dividend. For income-focused or risk-averse investors, Walmart is more appealing. Round 6, growth potential, Amazon wins. Amazon stock has outperformed over the past year. Analysts see significantly more upside. Amazon's diverse business model, Wad Cloud, advertising, retail, gives it more engines for future growth. So what's the overall picture? Amazon looks like the stronger company on most traditional financial metrics. Higher profits, better margins, more reasonable valuation relative to growth, and a stronger balance sheet. Walmart, however, is no slouch. It has remarkable consistency, superior capital efficiency, a long dividend history, and lower volatility. For investors who prioritize stability and income, Walmart holds its own. The two companies serve very different investor goals. Amazon is for those betting on high growth. Walmart is for those who want steady, reliable performance. But based purely on the data we've looked at today, profitability, valuation, health, and growth, Amazon holds the stronger overall financial position right now. Let's wrap this up. Amazon and Walmart are both extraordinary businesses. They each generate over $700 billion in revenue every year, a number most companies can't dream of. But the way they make money, the way they're valued, and the kind of investor they attract, those are very different stories. Amazon is a profit machine with high margins, a strong balance sheet, and enormous growth potential. Walmart is a reliability machine, consistent, dividend-paying, and economically efficient. The numbers don't lie, but numbers also don't make decisions for you. Understanding what they mean, that's your edge. And here's something to think about. The best store in the world and the biggest store in the cloud are now competing for the same customer and the same investor. Which one wins the next decade? That's the question worth watching. If you found this breakdown helpful, hit the like button. It really helps the channel. Drop a comment below, Team Amazon or Team Walmart. I'd love to know where you stand, and if you want more comparisons like this, make sure you're subscribed. We do this every week. Raw data, real explanations, no fluff. See you in the next one. This video is for educational and informational purposes only. It is not financial advice.